Hello and welcome back to Young and Visionary. You're with me, Esnat Suleiman, and today I will be talking about the risks of investing on the stock market. After the last episode where I spoke about investing on the stock market, there has been a lot of interest, people wanting to invest on the stock exchange, and I thought it was important for me to dive in a little deeper, give additional information so that you are well equipped before you start investing on the stock market. So when I talk of the stock market having the potential to give you a lot of gains, look at what has happened this year. From the beginning of the year to the 31st of March, and this is the year 2023, the stock market has returned a total of 29.44%. And that is just for 3 months. So if we were to annualize it, that would lead to a return of 119%. There is no other financial investment that could yield such a return. So that is the potential that the stock market has to offer to investors. What are the risks of investing on the stock market? Well, I think practically there are really two risks that an investor faces. The first one is the risk that they will lose their money on the stock market. So you buy your shares today at a price, for argument's sake, of 50 kwacha, and then 2 months, 3 months down the line, the price drops to 45 kwacha. You have lost money. So you're probably wondering, have I lost money on the stock market? Yes, I have. I actually bought a share like about 1.5 years ago, and the share price at that time was 21 kwacha. A couple of months down the line, the price came down to 17 kwacha. I know that for some of you who follow the stock market, you already have an idea of what counter I'm talking about. And I thought to myself, well, I've lost money, but probably this is the worst it can get. So I put additional money at the price of 70 kwacha. But that was not the end of it. A couple of more months down the line, the price went down to 11 kwacha. That is what I call losing money on the stock market. So just for argument's sake, if I had invested, let's say 210,000 at the time that it was at 21 kwacha, what it meant is at the time that the value went to 11 kwacha, my portfolio was sitting at 110,000 kwacha. I had lost a whole 100,000 kwacha. Ideally, that is what it had meant. So yes, that is one of the main risks that investors face when they invest on the stock market. The second risk is the risk that you may not be able to sell your shares when you want to get out and access your money. And this is something that we call liquidity risk. And the underlying reasons for both types of risk, the risk of you losing money and the risk of you being unable to sell, really emanate from the same underlying reasons. And I am going to talk about those reasons. The first one being what we call company-specific risk. So company-specific risks are risks that are unique to the particular company that you are holding. So you will find that companies operating in the same industry, one performs well, the other one doesn't perform well. The one that doesn't perform well, it's because of its own unique circumstances. The one that performs well is also because of its own unique circumstances. What are these unique circumstances? It could be the type of strategy that they're using for their business. It may be the type of management that are operating those businesses. So that is one of the things that as an investor you need to pay attention to. You need to understand the company that you are putting your money in. The second one is more what we call market risk. So market risk is not specific to a company. It's something that happens to the entire, it could be the entire economy, it could be to an entire industry. And market risk could be something like a natural disaster. It could be something to do with policies that are being implemented, political risks that are arising. So they affect each and every company operating in that particular country. And that is the sort of risk that is a bit more difficult to manage because it is beyond the strategy that a company can implement. So I've talked about these risks, but the fact that there are risks doesn't mean that you should not invest on the market. Actually, being aware of the risks helps you to invest more strategically so that you position yourself to gain from investing on the stock market. The fact that I've lost money on the stock market has not prevented me from investing on the stock market. It's just made me take additional precautionary measures when investing on the stock market. So what are some of the things that you can do to hedge the risk of investing on the stock market? The first thing, and I'm sure you've all heard this saying, don't put all your eggs in one basket. It could not be more true for the stock market. Make sure that you're investing in several stocks. So for me, when the share that I had bought lost value, when I looked at my entire portfolio, I did not make a loss because other shares had performed in that same period. So what you find is when you diversify your portfolio, other shares actually cushion the losses that you realize on other shares. Another way of managing risk is to actually make sure that you're choosing the right stock. And I'm very excited because in the next episode, we will actually have a guest who is a very close friend of mine. She actually works in investment management. She works with individual clients, advises them on which stocks to buy. And it is important because remember, on specific risk, it has everything to do with the type of share that you buy. So we'll be digging into the details of how you should choose the shares that you purchase for your portfolio. So I hope you hit the subscribe button. I hope that you will hit the notification button so that you were notified when the next episode comes out. Another thing that you should do is make sure that you're investing for the long term. The stock market is actually a place for long-term investors. The share that I spoke about that hit 11 kwacha is currently at around 15 kwacha or so. And you can see that slowly, if I had given up at 11 kwacha and sold, I would not have realized what I could realize if I wanted to sell it today. But for me, my reasons for investing are long-term. I have 3, 4, 5 years ahead to invest. So I am not under any pressure. So the advantage of investing long-term is that you're able to take in those losses with the hope that the share will bounce back in the future. Of course, that is not to say that you should hold all your shares for a very long time. It is also important for you to know when to get out of a particular stock. Another thing that you can do is to make sure that you're diversifying across asset classes. So what you find is that sometimes when the equity market is doing well, the fixed income market doesn't do as well, and vice versa. And this is normally because people are moving money to invest in the asset that is doing well at that particular time. So another way to manage risk is to ensure that you're diversified across asset classes, so that if equity market doesn't perform well, you cushion yourself on the fixed income market. And the fixed income market that I'm speaking about are the government securities that I spoke about in an earlier episode, your fixed deposits, your unit trust investments. So make sure that you have a balanced portfolio that is able to cushion risk in one asset class such as equity through returns that you're achieving in another asset class. So I hope that you enjoyed this episode of Young and Visionary. I hope that you have been able to understand the risks, not for the purpose of creating a fear of investing on the market, but rather for the reason of equipping you with the knowledge of what you need to do when you're venturing into the capital market, so that you can benefit from the returns of the stock market. Have a great day.